does the Fed believe that increased credit risk in the leveraged loan market pose systemic vulnerabilities, particularly in the event of an economic downturn?
So this is an important supervisory focus, and the headline answer to your question is we don't believe it poses systemic kinds of risks, but we do think it poses a macroeconomic risk, particularly in the event of an economic downturn. These are companies that have borrowed in good times and borrowed high amounts of debt, and if there is a downturn, they'll be less able to carry out their roles in the economy, and that may have an amplification effect on a downturn. Our supervision of banks indicates that the banks do not have excessively high exposures to these highly levered non-financial corporations, and also don't have excessively large pipelines of commitments that they've made. Those are two things that they did have before the financial crisis that they don't have now. So the banks, and that's our window into this, is largely through bank supervision. The banks have really changed the way they manage their involvement in this business in a way that puts the risk out in the holders' hands rather than the bank's hands.